using numbers and analytics to find properties, it seems like there's so many properties and there's so much competition for properties, especially when you're looking on the MLS and across the internet. In order to move and purchase properties at a faster pace, or to make it to a property and to beat your competition to that property, the best way to get there is to use numbers and to look at properties on a large scale, and to look at properties in a database or on a spreadsheet and to make sure that they're updated consistently. Speed is really an investor's best friend, and being able to identify properties that are a good deal is hugely important to being able to get to a property faster than the competition. I used to do that through spreadsheets. We still use spreadsheets, but the difference between a spreadsheet and a database is that a spreadsheet, the data comes in, you save it, you can share it with people. A database is, I'm not a super technical guy, but a database, the way we use it, it is kind of a living, breathing spreadsheet is kind of how it feels. And we have a live data feed that populates information in there. And as properties come onto the market, we have an API feed that feeds that database with the new properties on the market. And as the properties come into the database, we have things like the median, and we have a computer generated value for the property. And as the properties come in with that data, we take a look at the ratio difference between, say, the list price for a property and what the median price is for that market. So we would be looking at, say a property is listed for $100,000 and the median for that market is $200,000. We would be looking at, if you were to take 100,000 divided by 200,000, you'd be looking at 50%. So the list price is 50% of what the median value for that market is. And then on the flip side, if you were to look at a property that was listed for $400,000 and the median price for that market was $200,000, you would have 400,000 divided by 200,000, which would equal 200%. And so it would be twice as much as what the median is. And when we're flipping properties and looking to buy properties, it's a lot safer to buy properties that we can bring up and sell at or near the median, as opposed to buying properties that are far over the median. The median is where you're going to find more buyers and it's going to be more stable. The higher you go over the median, the less stable it is and the more it can drop off. And so personally, I like to buy properties below the median, fix those properties, and then sell at or above the median. But we don't focus on high-end luxury properties. Probability is very important to me, and not risking the investor's money. That's important for me. I really want to make sure that I don't lose the investor's money. That's, our number one rule in investing is to not lose money. And so your probability goes up a lot more when you focus on properties near the median. So in terms of analytics, if we're going to be looking at the median in relation to the list price, if a property is listed far below the median, then it's a red flag that that's probably a good property to take a look at. And so if you have 20,000 properties, it's really difficult to look through them really fast. And if 300 come onto the market one day, it might take you all day to go through those, or all week. It depends on how much time you have. And if you don't have a lot of time, you have to be very calculated with what you do. And by looking at numbers on a large scale and then using those numbers to shortlist properties, that feels about the most efficient way you can work with data, in my opinion. And so that's the reason why we created the software, was so that we can look at those numbers, we can feed properties directly into the database, we can look at the percentage difference, but we're also looking at a dollar difference. So that same example, if a property is listed for $100,000 and the median is $200,000, that would be a $100,000 swing. So we would call that plus 100,000. We would take the 200 minus the 100. That would be 100,000 difference. On the flip side, if a property is listed for 400 and the median is 200, that would be a negative $200,000 difference. And so on those, we're really looking for the largest difference in dollars. Oftentimes, it's better if you look at a certain price range and ratios, and you kind of, you go through these different searches where you're looking at, the ratio difference between a median and the ratio difference between the computer generated value, or you're looking at a dollar difference between those. And you take those differences and you sort by those columns so that you make sure that you hit all the properties. When you have 20,000 properties, if you were to calculate all the keywords and, put a value to them, and then you would get this keyword rating, we will give a value of 1 to 10 based on keywords. So, if we like probate, we would say the word executor or probate or probate court. Those sorts of words would get rated at a 10, say. And then we would have maybe short sale would be rated at a 9. And REO might get rated at an 8. And depending on how many of these words are within the comments will determine how high on the rating scale that a property scores. So then instead of just looking at ratio differences for list price to median or dollar differences of list price to median or the computer generated value, we're also looking at keyword scores across a large set of data. We're giving them a value. We're sorting from the highest probability comments to the lowest. And then we're just focusing on that top bunch. And every day properties come in. So whenever a property scores really high on that, if it's new into the system, that's something that we're focusing on so that we can evaluate it quickly on the surface, determine whether or not we want to go to the property. And if it is something we want to go to, we go out there as fast as possible. We determine the repair costs, the ARV, and we send off an offer. And just by being streamlined and automatic and systematic about this, we can beat our competition to get to a property, to make the offer, so that we can do more volume as we move forward. So that's basically an overview of numbers and analytics and why it's important for an investor to look at properties on a large scale. And it's very inefficient to go in and to just go through the MLS every day or to poke around on Zillow or Realtor.com or to hope that your real estate agent is going to send you the best possible properties. You need to be really diligent about how you search for properties and what properties you spend your time on going to look at, because it takes an incredible amount of energy to do this. So that's my talk on that, and hopefully that helps. click around, and hopefully you can find some other videos that help. Also, go to the podcast, Not Another Real Estate Investing Podcast. We've been putting some work in there, and hope you take a listen, maybe subscribe, and have a great day. See ya.